Hey everyone, and welcome back to Collin Investing. We're diving deep into the recent market volatility, and more importantly, the investment opportunities that are starting to emerge. The market's been throwing us some curveballs, and I want to share a couple of moves I've made in response. So, let's get started and explore what's happening and how we can navigate it. We kicked off with a look at the overall market situation, and it's clear that the volatility we've been seeing isn't just a blip. As of the 13th of March, 2025, the market continued its downward trend, and a lot of this is being fueled by President Trump's ongoing tariff threats, and frankly, the actions he's taking. We're seeing the S&P 500 down another 1%, the Nasdaq off by 1.38%. And this is a broad-based concern across various risk assets. This kind of uncertainty is exactly what's been driving some of the investment moves I'll be sharing with you shortly. So, we've established the overall market downturn, and President Trump's tariff actions are a major factor, but that's not the whole story. This brings us to a really concerning trend: consumer confidence, and not just a minor dip. We're talking a significant plunge. The Michigan Consumer Sentiment Index just released its preliminary March numbers, and they're way below expectations, 57.9 versus the predicted 64.0. To put that in perspective, that's the lowest level we've seen since November of 2022. In my years of analyzing these figures, a drop this substantial signals a deep and widespread sense of pessimism setting in among consumers. Remember that consumer confidence we just discussed? Well, it's directly tied to another alarming trend: rising inflation expectations. The latest data is pretty stark. The one-year inflation expectation shot up to 4.9% from 4.3% just a month prior. And it is not just a short-term blip. The 5-year inflation expectation also increased, hitting 3.9%, up from 3.5% now. You might be thinking, what does this mean for me? It signals that consumers anticipate significantly higher prices, not just now, but potentially for years to come. This raises serious concerns about how the Federal Reserve might respond to curb this potential threat to the market. So, with all this market turmoil, I've made 2 key strategic moves. I am always looking to capitalize on price changes and, more importantly, identify those emerging opportunities that volatility often reveals. I am actively responding to increased volatility. Building on that point about responding to volatility, one significant move I made this past Monday was closing out my short positions on Tesla, and frankly, it was a profitable move, netting over a 100% return. You might remember, I initially took this short position when Tesla's forward price-to-earnings ratio was soaring above 100, an absolutely astronomical figure, and made assessment to start shorting. So, why close the Tesla short position, especially since I just said I profited handsomely? Although the stock is still technically overvalued with a forward PE of 65, it's no longer in that ridiculously overvalued territory it was in before. We are talking about a shift. I have to acknowledge, and this is crucial, the sheer marketing skill of Tesla's management, and specifically Elon Musk. They have this uncanny ability to hype the stock. My concern isn't necessarily about Tesla actually achieving the earnings to justify its past valuations, but more about another cleverly crafted marketing campaign potentially sending the stock price soaring again. So I decided to book the profit because I am watching out for the moves made by Tesla's management team. The other move I made, and this is where it gets interesting, was buying Uber stock. I consider that Tesla's narrative has negatively impacted Uber's valuation. Now look at Uber's forward PE sitting pretty at 17, I believe, and this is key, that Uber's entire business is being dramatically undervalued. Why? Because of the pervasive narrative surrounding Tesla's driverless car technology. The market is behaving as if Uber will be absolute in some years. Tesla's narrative has negatively impacted Uber's valuation. The prevailing market sentiment is, and somewhat incredibly, that Uber's business model might be obsolete in a few years, entirely disrupted by driverless technology. I strongly disagree with this assessment. Imagine that a company worth billions is viewed in the market now as it might not exist in some years. Given its current valuation metrics, with an intrinsic value by my calculation at $112 a share, and the market price is hovering in the low 70s, I see Uber as an excellent investment opportunity. It's a contrarian play, certainly, but one backed by solid fundamentals. With that in mind, let's examine a crucial factor: the retail sector, specifically consumer spending. Major players like Walmart and Target are flashing warning signs, reporting cautious outlooks. What's happening? Consumer demand is softening, hitting low, and middle-income groups the hardest. Consider a situation where basic needs become a challenge. As Dollar General's CEO pointed out, these consumers are now laser-focused on essential goods, and that tells a story about broader economic pressures. And that's where the impact of tariffs comes into play, adding another layer of complexity. It's a ripple effect, really. Retailers are already feeling the pinch, with costs going up. Target, for instance, has explicitly stated that tariffs will put significant pressure on their profits. So, how are companies responding? Well, they are not just sitting. We are seeing a major push towards supply chain adjustments. Companies are prioritizing to mitigate these increased costs before they hit consumers. We just discussed tariffs impacting costs. So, how are retailers actually responding? Well, it's a multi-pronged approach. Companies like Walmart are aggressively pressuring their suppliers to lower costs, aiming to absorb the impact. You see, Costco is taking a different route, delaying any cost pass-through to consumers, at least for now. Across the board, here is a major focus on internal optimization. Think tightened inventory management. One encouraging sign, at least for now, is that we haven't heard any immediate plans for widespread layoffs or major across-the-board price increases. Now, let's shift gears and talk about wisdom. Investing wisdom specifically from a legend in the field, Howard Marks. He is the co-founder of Oaktree Capital, and he's renowned for his incredibly inshellable takes on market cycles, and, perhaps most importantly, contrarian thinking. What I really appreciate is that he's just given a new interview, drawing from over *50 years of experience. He is sharing invaluable insights which is directly relevant to the opportunities we are discussing. Mark's first core principle, which directly counters a common investing mantra. It is not enough to just buy and hold good companies. It is buying well, at the right time, that truly matters. I want you to consider a situation where you buy a great company, but the price is totally inflated. You are setting yourself up for a potential disaster. He illustrates this perfectly with the Nifty 50 stocks back in 1969. We are talking blue-chip names like IBM, Coca-Cola, and HP companies, but if you had bought them then and held for 5 years, you would have lost over 95% of your investment. It is a stark reminder. The best company in the world at the wrong price is a terrible investment. Marx highlighted a vital point that often gets lost in the noise: buying at the right price. He expands this by asserting the importance of contrarian thinking to achieve exceptional success. And this resonates deeply with my own approach. You have to be willing to do what others are unwilling to do. This doesn't mean being contrarian for the sake of it. It means resisting the urge to follow the crowd. Instead, you should actively seek out those opportunities in undervalued areas, the areas others are overlooking or dismissing. I always say that contrarian investing isn't a blind rebellion. It demands rigorous, independent thinking and incredibly thorough research. You need the conviction to back your decisions when everyone else is saying the opposite. Building on that point of contrarian thinking, Marx offers a brilliant framework for understanding market cycles. He makes a key distinction. In the real world, things tend to fluctuate between, pretty good and not so good. It's a gradual, often messy process. But, and that is a big but, investor perception is totally different. We tend to see things in extremes. It is either everything's perfect, buy, or it's hopeless, sell. And you might be wondering, where is the opportunity? Well, these extreme emotional swings, this herd mentality, is precisely what creates opportunities for calm, rational investors, those who can detach from the noise. Marx emphasizes a crucial point. We as investors can't predict the market with certainty, but we can absolutely assess its current state. Think of it like this: it is about reading the temperature. And that's where the concept of balancing offense and defense comes in. It's a dynamic process, not a static one. So, you might be wondering, how do I apply this? Well, if the market feels overheated, it's time to increase your defensive posture. This could mean trimming some positions, raising cash, or shifting towards more conservative assets. Conversely, when the market is gripped by pessimism and everyone is selling, that's often the signal to get more offensive, to look for those buying opportunities. This brings us to the next slide. This brings us to Mark's final, and perhaps most crucial point, the importance of humility in investing. He emphasizes that overconfidence is one of the biggest, if not the biggest, risks we face. We have to acknowledge, truly and deeply, that we cannot predict the future. No one can. I believe embracing this humility, this awareness of our limitations, is what helps us avoid those critical portfolio-wrecking mistakes. It keeps us grounded and forces us to consider all possibilities. Mark's wisdom about humility really hits home when we look at the semiconductor sector. We have seen some bounce in the share prices. Specifically, NVDA and TSLA saw significant gains, seemingly great news, right? But, and this is critical, the overall trend is still uncertain. It's like a tug of war. For NVDA to truly signal a sustained upward move, it needs to break that $125 mark. Similarly, TSLA requires a rapid breakthrough to maintain its upward trajectory, otherwise we could easily see a reversal. I am keeping an eye on these levels. Given this resistance that NVDA and TSLA are facing, it is crucial to broaden our view to the entire semiconductor sector. The SOXX, which is a key semiconductor ETF, is facing significant resistance. So, what does this tell us? I expect we will enter in a period of volatility and consolidation within the semiconductor space. I see a limited upside potential for the overall market. If it is solely relying on semiconductors to drive growth, we need other sectors to step up. So, given those challenges in semiconductors, where does that leave the broader market? Let's take a look at SPY and QQQ. For SPY, I've identified a potential, and I emphasize potential golden pit buying opportunity if we see a pullback to the $510, $530 range. That's a level I'm watching very closely. As for QQQ, there are key support levels that we'll need to keep an eye on. I will keep you updated. The key takeaway here is this. Diversification is going to be absolutely crucial. We can't just rely on one sector anymore for sustained market gains. We need to see other sectors pick up the slack. So, where does this leave us? I am seeing continued volatility, certainly, but that also means continued and potentially even bear buying opportunities. I am personally prepared and have cash ready to make further investments if the market declines further. The core message here, and it echoes everything we've discussed, is the vital importance of adapting. We must be dynamic, to be responsive to these ever-changing market conditions. The static strategies are not enough, and that wraps up our deep dive into the market's twists and turns, and I hope some valuable insights on navigating them. I am keen to hear from you. What are your thoughts on the current market? What investment moves are you making or planning to make? Let me know in the comments below. Your perspectives are incredibly valuable, and they help us all learn. Don't forget to like and subscribe to stay updated on my latest analysis and strategies as we tackle this ever-changing financial landscape together. I am Collin, and I'll see you in the next video.